When you look into the financial due diligence, typically you ask for what's called the T12, or the previous 12 months operating books, the profit and loss statements, cash flow statements. And so we go through the actual T12, not what the broker is giving us or not what the seller may have advertised initially. We look at the actual T12. And one of the steps we take is we try to then track that or trace that to the bank deposits that they have made. So we take an extra step and say, hey, okay, you're telling me that this is the revenue that came in and these were the expenses. And can you prove to me that this was the actual revenue that came in and was deposited into the cash that came in was deposited into the bank. So we sort of try to trace that, make sure, validate the statements a little bit. And then we do our underwriting. So we have our own financial model that we've built over the last several years. And we stress test the projections based on certain assumptions. So we look at what would be the break-even occupancy of the property, what's the cap rate when we are looking to sell the property. So we generally increase the cap rate, which means we assume that the market's going to be softer when we sell it, but we stress test it at multiple levels to see how much of a downturn we can sustain in the market while still giving a good return to our investors. And then we obviously do some forecasting and stress testing around refinancing as well. Like if we had to extend the refinancing period for a while, or if we get a different interest rate than what we're anticipating, et cetera. So once it passes those key assumptions and metrics that we have, then we go a step further. We put a LOI out, which is a letter of intent,